we are on our way.
Yeah, another and a higher rate increase in February as well, right?
Probably.
Probably, yeah. So I think the thing is Powell is doing what he's saying he's going to do every single time. We just don't want to, we just believe he's going to do something different, right?
Yeah, right.
It's like, don't fight the Feds.
Pricing is getting better though in some sectors.
Yes, it has to open up, right? Otherwise, it's
Yeah, it feels like it's starting to stabilize, and the world's just sort of accepting where we're at the moment.
That's right. And when we take a look at it, it's the whole, I think after this one, we are going to believe it's higher for longer, and that is it. Not going to fight anymore, right? I want to give up. So that's acceptance happening.
It'll be a new world, and we will work within that new world.
Yes. Hey, Trevor.
Hi there.
This Trevor amazes me. He was last night in Houston. He's in Austin. He was in Houston. Went back to Austin. Had a party, and he's here. And I saw you like 2 other meetings. Man, it's something else.
Got to show up.
Everybody, we're gonna get started in a couple of minutes. Let's see if Mike can.
Great to see you, Trevor.
Good to see you.
That's Mike. All right. Everybody, thank you for joining in the evening. I know it's getting cold and dark in Houston, I should say. That's it. Paul, just to let you know, Mike is gonna pick it over around 6:30. I have a wedding event to go through. To
that's right.
6:30, so I have a hard stop.
Okay.
I'm here.
Hey, Mike. Let me. I missed sharing my screen. Please let me know when you can see it.
Can see your screen.
Awesome. Thank you. And I'm looking at two screens.
I'll take over the unless somebody else was doing it. Sure, I'll take over the
Okay.
controls and things.
Awesome. Appreciate it. I'm kind of kicking away, so.
I kind of view we had an incident not on our Zoom, but one of our associates partner Zooms a week ago that got hijacked.
Oh.
And was really bad.
Sorry. I saw it a couple of times at the very early in the COVID time. They'll come in and start messing around. Okay. So Mike, just let me know when to get started. Maybe we should give a couple of more minutes. Then we're gonna kick off our 65.
Yeah, sounds great. I'm just getting
Hey there, Mike. I was there. It was not fun. It was funny, but it was not fun.
Oh yeah, Svedlo was on there. It was. I mean, if you were if it was your Zoom, you'd be like, man, I think we should just shut this down and come back. Probably, I don't know. It was Alex's Zoom, and he managed through it. So,
Man.
Yeah.
Hey, look at this guy. He's at the gym. And he's also at a webinar. I mean, he's working out his mind and his body. Very nice.
2 for 2.
Yes, sir. I was earlier with a phone call with Alex. That was with Jeremy. That he was on this Monday. I was with a phone call with him. Then I had another Zoom earlier, so I got to make it the best of it. They got to drive
Nice.
7 hours afterwards, going to Miami.
Oh, wow.
wow. I'll see you Friday, Svedlo.
I'm so looking forward to it, Mr. Bailey. I'm so looking forward to it, and everybody else from you guys. Thank you for Massive Capital. Thank you.
Thank you.
And I walked the property today.
Oh, over in Fort Pierce property.
Tomorrow I'm gonna miss it because I have to unload at 3 o'clock. I asked if I can unload earlier, but they couldn't take me, so I'm gonna have to miss it. But I'm in just south of Nashville. It's one of my most favorite. at Franklin, Nashville, Tennessee. That city is amazing, a lot of potential. So see what happens.
Awesome. Love to hear about it when we meet up this week.
Yes, sir.
Okay.
Thank you.
All right.
All right, Mike, 6:04. So before I get started, I say
You
something.
already started the recording, right?
Yeah, I did. This
Okay.
time I did it. So
All right.
I have some friends from Jake and Gino community. Really appreciate you guys joining. I believe it's the first time I'm seeing you guys, so thank you. And I'm scared now. I'm nervous. All the questions I'm gonna get. So, but bring it on. It's gonna be fun. Okay. So what's the agenda for the day? I am keeping my PowerPoint on a PowerPoint mode, not in a full display mode, because I'll go back and forth between the co-star and a bunch of other stuff, just to kind of give you a flavor of how we go through it. We're gonna run through as kind of sort of quickly, and then we have 20 minutes for Q&A. And so okay, first couple of minutes we'll spend some time about who is Massive Capital, how we work, and our business strategy, and also what the market view of our world, or how we are believing the market's going to go and how we're acting on it. Then we'll get into the case study. It is, typically when we talk about underwriting, in my mind, we have a bunch of different sections to it, which is the market, location, property, and everything under the property, which is typically the Excel file, right? And for us, when we do the modeling, understanding the context and the setup, that tells how the numbers should behave. So last webinar, we talked about the market, how we typically get into the market and understand the market dynamics of it, like, the characteristics of Houston versus Dallas versus Austin versus Denver versus Carolinas, that kind of stuff. This one we'll get into a little bit more, hone into it, as we get into the specific property location, how do we take a look at it? And you'll see everything that we do has an hypothesis, and we try to prove or disprove. So to make things interesting, I know it's like in movies, right? Everything got to have a good ending, but we'll show you some of the struggle that we go through, that sometimes we're trying to go for and kind of go after the data which we don't have. Then we have to make a decision based on the data is missing. And on the other side, we'll show another example where data was available and the data told us exactly what to do. So in the first half, I'll run, then I'll give it to our partner, Nick from Hampshire Capital. He's here, he's gonna give you 2. So we're gonna go through 2 case studies, 15 minutes each, and then we'll open up for the Q&A, and then we're gonna head it up from there. So having said that, first introduction a little bit more. On the right side, it's us, the Massive Capital. It's 4 partners. Ajit's not here. He has family event that he has to attend. We have Sanjay, he's the COO. After we buy, he picks it up. So he keeps us in check to make sure that we don't buy too crazy of his stuff for him to manage. I work as CFO to make sure that financially and the engineering behind the finance, it works through, and the liquidity and the market forecast and a little bit more strategy. We have Mike. He's managing all things money. So, hey, I'm broke 24/7, but I know the bank of Mike Bailey. That's how we roll. Now, we also have 2 big partners. Paul, thank you for joining with us. We are working quite a bit. We are heavily integrated both with Paul and Ash, but Ash couldn't make it. He's going to Cancun, then Egypt, then something else. But Paul is here. Paul, would you like to take a couple of, about a minute to kind of introduce yourself, please?
Oh, thank you, Shar. Yeah, so I am a physician that just retired last year as a head and neck surgeon for 30 years, had real estate company on the side, a family company, kept growing that over time. And then now that I'm retired, I'm doing this full time. And we have, I work with my son and my daughter also in the business, and they work for us. Our name of our company is PSC Properties. And this last year, we started working with Massive Capital and have enjoyed it a lot. Hopefully, we are adding value to each other and doing some deals in Texas, and it's been awesome. So my past experience is you can see it there a little bit, and we've done quite a few development projects. And so we're working with development with Massive Capital, as well as our other value add properties. So
Paul was kind enough to miss out the whole thing. I mean, he has done more than 40 full cycles. He has 1,000 units under development. Anything we name it, and when we get stuck, we call Paul. And it's all of there to kind of advise us out there. So thank you, Paul. Really appreciate you being here.
Thank you.
And so on the massive side, one of our big beliefs that we have, we don't get into a location and or we don't operate or buy into a property that we don't have the expertise to run it, or we don't know about the location, right? So that's location expertise matters. That's why 100% of our property partners that we have partnered with bought the assets together. We collectively own assets, so we know how to operate that into the location. At the same time, our partners and or us have the capability of running an asset. So one of the case study that we're going to do, it's a Dallas 419 unit. The key takeaway, key structure, one of the key things, we had $19 million of pref check from Walker Dunlop, which is the public company. Given the large institutional check that we brought in for that development, for that deal, they expect us to have a certain kind of a structure within the company. Hampshire had it, and Hampshire, their specialty is bringing in those large institutional checks. And they have in-house construction manager, in-house asset managers, and also acquisition managers. So they are structurally a bigger team than us. They have much more folks in-house, so they can large. So they are a little bit more. They're way more integrated than us. Even though we have 4, they have 7. Hey, I'm a little jealous. But that's how we partner with them to take down the 419 units. So we make sure that we can deliver the project. On that note, we invited, or do I call it, I dragged Nick into this webinar today. Nick, so he is the COO of Hampshire. He's going to run the latter half of the meeting. Nick, would you mind take a quick introduction for all of us?
Sure, I'd love to. Great to be here. Thanks for having me. I've been in the multifamily and apartment business since 2007. So I've had the, I guess, luxury of living through the 08 financial crisis and downturn and watching the run back up. And now we're sitting at another inflection point, which will be interesting to see kind of where it goes from here. But I've been involved with the acquisition and renovation of approximately 5,000 Class B and C apartments over my career. Hampshire Capital is about a 2-year-old company, but myself and my partner Shane have been actively involved in real estate for collectively almost 50 years. And my partner's background is a diverse real estate background, everything from land development to multifamily to single family development. And we're approaching Hampshire from a perspective of building a vertically integrated company where we can control all the controllables, minimize the risk, and do our best to execute and deliver outstanding returns to our partners. So we have a full-time asset management team. We've recently started our own vertical construction component of the company. And we plan to at some point phase into third-party management, in-house management as well, and phase away from third party. So we're taking a very much a operator asset approach to all of our investments versus just an acquisitions type company. We are heavily focused and committed on execution, on the execution side of the business. So
Nick, thank you. Really appreciate it. So as you can see, our team is structured, our specialty is the retail equity, their specialty is the institutional equity. Given the market, we have, we can lean into each other, and the structure supports it. Behind us, we have, our backbone, Paul and Ash. So put together, it's a team. Every deal is important to us. It could be $3 million to all the way down to 60, even more, higher. We have a couple in the pipeline. We'll talk about it. But if the team matters for us, the experience matters for us, and then we get into the asset, not the other way around, where we put a property under contract and then trying to figure out a team. So that has been our model, and we appreciate all the support, and so far it's been great. Typically, how we model is that we partner heavily. We believe partnership is the way to grow, and we also know that we're not gonna have all the skill set needs to be on the table to partners. So we reach out to the rightful partner and we partner. The whole thing is about the acceleration. Our job is to accelerate each other's growth, not to decelerate or make a status quo, right? So in other way, we work with the partners from deal sourcing to PSA to at-risk to loan guarantor, equity investors, and asset management throughout the whole thing, depending on who needs what. I kind of ran down. So our business strategy and market update. Quick, our deal board. Right now, we have 3 properties under contract. And not in North Carolina, will be Austin, Houston, and Dallas. LOI pending 4. We're actively underwriting, I believe, 13 total. And other activities, we should have 2 or 3 opportunities coming up soon, next 2 weeks, I should say, after the Christmas. So we're going to bring it out, and fund, we are working to release our first fund right around the same time as well. all in all, last 6 months since we started, it's about 10 months now. Paul will tell me 6 months. So last 6 months, we bought 8 assets under umbrella. Those are the assets that we bought. Those are the green locations. And we are looking to close a new development in Houston in April. And recently we put under contract in a new development in Austin. This is hot off the plate. We went under contract today, last night-ish. And we have another property we're under due diligence. That's a 88 units in San Antonio Valley. We are at the end of the due diligence, and we'll finalize. We'll get into the non-due diligence period sometime next week. Okay. Time for fun. So I'm in time. So sorry, I had to go quick just to make sure that I catch up on time. When we underwrite, we kind of take a hypothesis-based approach. We have 3 big categories, which is the market. That's what most of the folks will do top down. Look at the macroeconomic cycle, interest rate forecast, and also 3 years life and multifamily life cycle. What we try to ask ourselves, do we have a directional belief what's going to happen 3 years from now? Knowing that we're going to be wrong, but at least can we take a position and defend it 3-4 years down the way? To do that, the macro outlook, economic cycle, macro outlook of the economic cycle, where US at, where US versus Europe at, and then and the interest rate forecast and multifamily. We try to be unbiased.
你要吗？
So
或者
we-
那个 rental 是这个
So sorry. So we try to be unbiased in a sense that we follow Feds. One of our big philosophies that we don't fight the tide. So we want to be on the side of the market. We don't want to do something that puts it against us. We'll talk about it, what we have done this year, but that's our belief. Then on the location perspective, we do a bottoms up. That means every real estate is ultra focused. It's a hyper local. So that block, the zip code, that street, the railroad, the river, the bridge, that matters, right? So that ties into back then. We don't get into a location where we don't own assets, and we don't get into a partnership where the partnership doesn't know how to run an asset locally. So that saves us from there. And then the project risk, which is once you buy the asset itself has a risk, and what is the story behind it. So I'll talk about more or less the bottoms up approach, how we take a look at it. Our underwriting process on the macro perspective, this was 2 weeks ago. We are forecasting 25, interest rate being 4.25 to 4.5. We had about 70% bias for the interest rate hike, which happened today. We believe we're going to be in a recession in Q1. That means market is happening. By the time we feel the pain, it will be about 4 or 5 months out. Interest rate forecast, it is higher for longer. It's not up and down or anything like that. There's going to be one more increase in February. Then it's going to stay for a long time, year and a half, then it's going to go down. And multifamily life cycle, it's in a contraction mode. Putting together, a lot of people a lot of syndicators, especially these early on, especially who bought assets on a floating debt, they're in a world of pain. And the pain is here to stay. So for us, we have positioned ourselves with the balance sheets. So we are lendable. And second thing is right now we're positioning ourselves for equity. So we can go through the cycle, take the projects through, and we go. And most of the projects that we're buying on a bridge debt, make sure the cash flow or we have enough liquidity to support, to make sure when we stack a bunch of projects and go through that tough time, we're still solvent and we don't make any bad choices as we go. And so it's the second underwriting. Now we're going to go down to the one level down, which is location risk, bottoms up. Typically, when we look at it, we look at, hey.
I'm not sure. So there was not just checking if you can
Okay, maximize this.
share the screen and there you go. That might help some people. Thank you.
Okay. So on the location perspective, when we look at it, we try to understand a couple of things. What is the cost of labor and the cost of material for the location? Think about Seattle versus Houston. They're dramatically different. And what's the same that boils down to cost of CapEx, supply, and everything else? And then what we really hone into is the revenue. And based on the OpEx, CapEx, and the market, that's the debt kind of shows up. On the revenue, we believe multifamily is a revenue game. It's not a cost game. We're not gonna make operationally, cutting the cost on the OpEx is not gonna win a deal. It's not gonna make us money. What's gonna make us money is the revenue. So we are sold on the Kool-Aid, and that's how we believe. So every time we look at it bottoms up, we try to understand one question: how can we confirm the revenue forecast? What is giving us the confidence to make sure that that we know whatever the forecast that we are we're going to do, that makes sense. And the case study that we're going to do, 2 properties, Anderson and McCullum. In the Anderson, we'll walk you through how we go about, at least us Massive, we go about it. Then you'll see how Hampshire goes about it. 2 different style, but they go through and trying to get to same destination. And with the Anderson, the interesting part is we don't have any answer. We just didn't know how to solve it. And I'll walk you through how we are making a little bit more science and art together and trying to get the idea about what, how we trying to model. Okay, let me undivide that. So let me open up that one. Give me a second. Anderson. So Anderson, this is a listed and a product. It's been on the market for a while, and it went through 2 brokers to get to us. And I believe I saw the property sometime earlier this year with one of the brokers. We didn't quite ready for it. We didn't know what the market was going, so we kind of stay paused. Then it came back again. He was kind enough to join our webinar last week. He sent it to us. We took a look at it. It's a nice product, right? Product is nice, no doubt about it. And the question is, as we underwrote it, we wanted to understand, again, going back, what does the revenue? So the setup is, it's a brand new product. It should be, the completion is in March 2023. The developer knows market is not his side, so they're not going to go through the lease-up process. They want to cut that project out and looking for a buyer who's going to go through the lease-up process. So for everybody here on the multifamily side of it, for a new construction, there are 3 dips you can get to the stabilization. First thing is the construction. Second thing is lease-up, and then is the stabilization, right? When you do a lease-up, we try to get warm bodies with decently paying rent. Then we do a cycle through and try to bring them up to the market rate. Typically, when we buy a product with the lease up, we take that leasing risk, and then we kind of stabilize and exit from that point. So that's the setup. Then I'll walk you through how we kind of go. The first thing what I've done, or first thing what we do, given it's a Houston area, we want to know the OpEx part of it, which is in the Houston area or in a coastal area, anywhere in the OpEx, we have 2 parts, controllable and uncontrollable. And from the uncontrollable perspective, the biggest thing in the state of Texas is the insurance and taxes. So this is the county office. I can overlay the FEMA map, and this is the property. And first thing is, okay, that's the area. And can I overlay the flood map? And you can see this is not the area, it's not in the flood. So what happened is they have a detention to capture the water, and they got a deviation out. So the property is not in the flood zone. So what's going to happen when the interest rate goes up, the properties in the flood zone area, they escalate at a much higher rate than a normal. So by design, we could tell, hey, we'll have a better rate increase as you go take a look at it. So, okay, it's normal. It's not abnormal. And also, we know this is what it is. So when I go into underwriting, I need to have the elevation of the property, so I really can challenge the insurance company to make sure that they're not going to put us in a flood zone. Second thing, it's right next to the neighborhood. Those are all nicely built and properties coming in. This is Beltway 8, and as you can see, this is all in flood zone. Now it's Houston. One of the coolest things is that Houston, I have a residential business. We buy quite a bit of properties. I used to live in Shadow Creek. Right where? Right here. I have properties on the east side of the property, on the west side of the property, and north side of the property. So I know the characteristics of the location. I knew back in my mind that area floods, but I pulled out the map just to make sure it is there. So the location checks out from the OpEx. Second thing is the entrance. This is a 2-way lane, and this is a 4-way. So anything, I knew that anything that comes from the Beltway, this is called Beltway 8, the freeway, it is gold. You come in, there's a dramatic price shift. If something is 200 grand here, it is 400 grand, the same exact thing, even older, just because you come from this access. The access matters. And the second thing is there's a big thoroughfare, it's called 521, which is the Alameda Road. In Houston area, what we call it, we have one major hub, as you know, which is the medical center, which is right here. And all those new developments, it's here. So everybody takes this road to go. So this road is a major thoroughfare between connecting a big residential hub here, like across the whole thing, down south, that one. It's right here. So there's a big push of traffic right there. It gets really bad. And they did a lot of construction to improve that here. So I know that we know that property is closer to a major thoroughfare, which is a good thing. It is not on the flood zone, which is a good thing, right? So that was the first. It kind of checks out that. And the second thing we looked at is the capex. It's a brand new project, so there should not be any capex. It just put some touches or make sure have new furniture in the office, that kind of stuff, which is a good thing. And the last thing was the revenue, and that's why I think got interesting, right? So this is what the fun part will happen. Let me share more screen. Okay. So, all right. So I'll go back and forth based on what we have. So on the CoStar, which is from the multifamily perspective, and then I'll try to proxy, right? So first thing as we go now, what we do is that we try to look up the, give me a second. There's a website called Justice Map. I love it. It's a really cool place to go get your, hold on, let me see. It's a really good place to go to make sure that your property or your location that we're doing, it's a very good demographic. So save it. Justice Map has the broken down by the race and also by the income. When you go to income right here, this property is right here. Right on Anderson right here. So trick, $50,000 right here. This is the median earning. So 50,000 divided by 12, roughly, I'm just gonna simplify it, roughly 4-ish, right? On the 4-ish, then 1/3 will be a rental. So 4 divided by 3, you're looking at roughly $1,200-$1,300 max somebody should spend in that area. And then we have to figure out which side of the freeway is it in. Is it on the south side or north side? So on the north side, there's a dramatic drop in terms of the earning power. And sorry, here. And as you can see, the property is right here. I'm at a 49,000. So question was, it's a brand new build, and my broker was saying that all of the comps that's on the broker channel was $2 a square foot. And my question is, can we get $2 a square foot, right? $2 a square foot on the average size is $1,400 plus bills, plus utilities and fees and everything else. So really, we have to check if we were to pay the price that they're asking for. We need to confirm that the tenant base there can pay $1,600-$1,700 a month to stay in this property. Just a simple math: 49,000 divided by 12 divided by 1/3. They're just not there. Right. So the question is, what is it? Am I missing something? Whether it's the tenant base is not there, given the setup or not. Given it's a new build, we wanted to push the envelope a little bit more. So we want to CoStar, and because the broker said, if you take a look at it here, on that, all the comms that was given here. Sorry. And I'm sorry, Katie, I love you guys, but hey, you gotta, let me do my homework. Let me see on the comps. Where's the comps? Okay. So all the comps, so this is the location here, and majority of the comps that were showed, it was right around here and right around here. Those two locations are dramatically different than this location. So when I saw the broker valuation and the pro forma that was forecasted right here, look at the, make it bigger. So they're saying that my average rent to have that, I need to be about $1.06 to $1.05, that's range. And look at the average rent, $1,600 plus utilities bill, you're almost $2,000. It's just not gonna work in that, in that location. Then I said, okay, that let's dig into the comps, right? The location is right here, all the comps are right here. On the 1, 2, 3, 4, 5, 6. Now the problem is the Shadow Creek is a well-built, well-developed area. This one is a well-built, well-developed area. The houses here goes from $350 at a minimum to $600,000, $700,000. And then this one is up and coming right by the freeway. So we said, okay, maybe I'm missing something. Maybe there's something else we don't know. The first thing we do know based on the demographics, the rent or the comps is not quite a good fit for the property. And the local demographic doesn't justify the money it needs to stay in that area if I were to pay $28 million, right? Then we defaulted out to see is there anybody else up and coming in that area. So we pulled out the map here. This is the property. And then I filtered out in CoStar all the new development up and coming. We thought maybe we're the only oddball, or maybe there's something else coming. So we see some new developments here and here. But then again, this is a well-built area. This is a well-built area. This is closer to downtown. This is just different. So another way, this property is going to be standalone property. This property is going to make the market. There's nobody's going to be here. Either you're right or you're wrong, right? So we saw that. Then we said, okay, there's nobody else. Rent doesn't justify. And maybe let's look at the residential area. See what would that look like. Maybe I'm missing something. So we went to the residential area. And we said, okay, all the houses were sold in that area. The Anderson property is right here, right here. And what is the price of the properties that around the area, so we can kind of sort of see, right? Nick will talk about it, but houses are selling for 150, 230, 225. With the 8% interest rate, it takes about $1,600, $1,700 to get into a door to buy a house like that. So on one side, we have apartments, $1,600 to rent. Another side, $1,600 a month, get you in a house. So it just doesn't match up. We know that area of the pricing structure that we need to do is just not right in that area, right? But we failed to get right comp because there's nobody there. We could not get a proximity check because nobody was building. We went to residential area to understand what the residential price is, so we could see what is the cost of buying a property there versus what the cost of rent. And if the cost is too high, then people will tend to rent. In this case, it's cheaper to buy a house, right? So the rent is not right. Then we said, okay, let me go check the rent again. So we pulled out the rent comps in that area just to triple check. So on the rent comp, as you can see, this area, $1,500, $1,400. So the renting a house is cheaper than renting an apartment, where we are the only one trying to set this stage for the market, and there is no gentrification there. So it boils down to a point, the pricing that we have, it is much higher, much lower than what the broker has to be, right? And that's the only thing it tells us. Now we have to design what is the right price. That means we have to come up with what the right rental amount here, right? So that's because, you know, it's interesting at some time that we don't have cookie cutter answer. We don't know what it is. We just go proxy, then a proxy, then a proxy, then a proxy. So in this case, what we have said, look, as of now, for me, if we were to design a price and say, hey, what is the market rent would be typically, I need to take the broker price and slash into about 70% to 60% of it. What it tells us, the market can support a rent for $1.20 to $1.30 a square foot, not $1.60, not $1.70. So that's one. But then again, we have to go back to a broker and break some hearts. Before we do that, we thought we need to get another validation beyond what we're seeing. That's where we reached out to some of the property management companies that we work directly in Houston, who specializes lease up. And we reached out to them. We shared our opinion. They're doing the calculation. They're going to come back to us within the next couple of weeks or so. We'll share notes. So we have a subject matter expert who specializes lease up product. They're going to tell us what their view of the world. We're going to share what our view of the world will come together. We're going to set the revenue. And once we set the revenue, we'll go back in, get the debt on top of that. That's going to calculate an offer, and that is going to be our offer. I'll take a pause. It's a lot. I went through quick. So just want to make a point that underwriting is easy, but it's not easy. Sometimes we have very ambiguous data. Sometimes we just don't have the data. And the point is, unless you know that area, unless you have an association bias or location bias or pricing bias, it is tough to calculate, especially an empty building, pricing on it, right? So I'll pause. I'll take some questions if you guys have anything before I break out or not. So hey.
I don't know if you all have ever seen this kind of underwriting that Schreier and the massive team do, but this is excellent. It's, as you can tell, it's not just numbers, it's demographics, it's looking at multiple different websites that confirm the demographics and all that's involved here. So it really does nail it down to some very specific data. So good job, Shar.
Thank you. Again, I keep the questions coming. We have 20 minutes on the Q&A. So flip the, slide decks to Nick, but this is going to be easier. And again, full disclaimer, we bought the property about 6 weeks ago. We took over 6 weeks ago, and we have some gap funding, and we are raising the funds to 506C, so we can talk about it. But right now we're not talking about the revenue perspective, but we thought we'll show you how we went about that, about how can we confirm the revenue forecast for the McCollum deal, what gave us the confidence. And I'll pass it on to Nick, and he's going to give his way of underwriting it. Again, revenue has to make sense. So Mike, this is all I had for the slide deck. Then just Q&A. So I'm going to break out, and I saved this one in our webinar drive under today's date. If you can pick it up from here. And Nick, it's all yours, man.
Okay, thanks.
Thanks, everybody.
Thanks, Shar. Enjoy the festivities.
Yeah.
Thank you.
Thank you.
Thanks,
Take
Shar.
care.
Thanks.
Oh, wait. So Shar, hold on. Who's got I apologize, the presentation though. Let me get it.
Yeah, Mike, I think you guys can see my screen.
There you go. Yeah, perfect. Thanks, Nick.
Okay, so we take a similar approach to the massive team, where we are very much demographic driven in how we look at selecting our investments, and really how we craft the business plan for each property. It kind of fits into two buckets for us. We have some sort of general criteria that we'd like to see in a potential acquisition before we even get to rent comps or underwriting or pro formas. I always start with a sort of top level demographic look at the project, just to make sure it checks some various requirements that we like to see in deals. And every investment group and every operator has different parameters around this, but I'll walk through some of the things that we like to see and things that I look for, things that are green lights, things that are red lights, as far as me moving and deciding to spend time on a full-blown rent comp analysis and full-blown underwrite. We do strongly believe, and this is one of our sort of ethoses at Hampshire, is that we really buy submarkets and neighborhoods first and properties second. You can change a lot of things about how these properties look and how these properties operate, but you can't move the property. And so you are ultimately stuck with the demographics of the areas that you buy in. And so it really is paramount and important to spend a lot of time really understanding the demographics and the resident base, both what's at the property now and what may be in the greater area that you could attract to the property as you try to raise rents and renovate the property. Like the massive guys pointed out, it is really a revenue game. There's only so much you can do on OpEx. And so for us, if we can't get a lot of confidence around our ability to scale the rents up and increase rents to justify and drive NOI growth, the property is just not going to be interesting to us, and it's going to be a deal that we think has too much risk associated with it relative to the demographics of the area. So, for us, I always start off by looking at, what is the 1 mile and 3 mile median income. We like to see about 50K as a minimum, just because we're looking to attract kind of a solid workforce, at a minimum, a solid, B-class workforce type resident to our properties. So we want to make sure there's at least a baseline of income there that generally can afford to pay rent. They're going to be well occupied. They're going to be good tenants. And one thing that we do that the massive team alluded to as well, but not a lot of operators do, is, we like to test right out the gate, and we like to look at what is the affordability of the in-place leases. And then we try to forecast kind of where we think the leases could go relative to the incomes of the area. So very similar to what we just ran through on the Anderson deal. I'll take the rent roll as I'm going through my top level demographic screen, and I'll try to understand relative to where the leases are today. Do we have at least a 3x ratio between the area income and the current leases? And if that's below 3, I probably won't even move on to do any more work on the deal, because to me, the leases that are already in place are already potentially stressing the resident base, which, maybe you can continue to rent to residents, at, below 3x revenue multiple, income multiple, but you're probably going to run into more operational risks, more bad debt, more collection issues, and it's going to put pressure on your ability to raise rents over time if there's not enough cushion with where the in-place leases are relative to where the overall incomes are within the 1 mile, but the 3 mile as well. So just an example of the in-place rents at McCallum. This is as of November, the month we bought the property. 871 is the average lease. We're at almost 5x ratio to the area median income. And then, looking at our pro forma rents, untrended and trended, I like to look at both. I like to look at just sort of baseline, where do we think the rents can go? And then even when we layer in the rent trending, the organic rent trending we're projecting for the market over the whole period, do we still have comfort and cushion that we can at least continue to raise rents to that theoretical 3 times income ratio? And this deal checks all of those boxes. And then once I've done sort of this first pass analysis on the rents, I'll then dive into the comps, which I'll show you guys here in a minute, to try to understand where the comps are. And then I kind of triage kind of what the comps are doing in the market relative to the incomes, relative to what I've concluded the sort of range of rent should be on a pro forma basis, to again get another layer of comfort that what we're projecting is achievable. And we never try to go into a market and set the market. We always want to have kind of 2 things. One, we want to check that affordability box where we're hitting that 3x ratio. And 2, we want to make sure there's some proven concepts already in the market that we can trail. And again, to give us kind of further de-risk our analysis on the rents, because that really is the most important thing to consider when you're underwriting these deals, is where are your rents today and where can you take them with confidence over 24 to 36 months as you work through a renovation plan. For the McCallum asset, once I get through sort of this preliminary income and lease analysis, I do like to look at home values. We've got very high home values here, and I'll show you a quick Google map in a minute of kind of where this property sits and kind of what's going on around it. But we've got $580,000 average median home value in this submarket and immediate neighborhood. A mortgage on a home like this is well above these levels, and so we don't feel like we're going to be competing with a single family home rental market here. And I also like to dive in a little bit on what are the top industries, what are the top occupations. I like to see some a decent level of both industry and occupation diversity, and if they're generally what I'm looking for here is something less than 20%. So this tells me that in the top 3 industries, we've got a pretty diverse employment base here. And if you do find a market where you've got a higher concentration of a particular industry, that's not necessarily a bad thing. But if you looked at this and 35% of your employment was in construction, and we're going into a recession, and you're trying to raise rents $250 on that resident base, it's just a reason to pause and think twice about, is that the right plan? Is it the right time for this property to execute that? Is it the right potential resident base, to execute a big value add rent push type program? And then again, the occupation breakdown, and I pull all this data, the incomes, the occupations, from a source called Neighborhood Scout, which basically takes the submarket, takes your address, and then does a very micro look at the micro neighborhood, which really gives you a flavor for almost like, what is your immediate tenant base? What are their true demographics? So it's even more niche and more focused than a 1 mile or 3 mile analysis. And so, and then lastly, another big thing we look at too is, what is the projected population growth within a particular pocket? This particular pocket of Dallas over the next 5 years is projected to grow 21.9% population wise, which is just incredible when you look at, the US pop grew less than, call it 1/10% in 2021. Dallas as a whole in 2022 grew 1.4. We're growing at roughly 3.5 times that in this one pocket. So, putting together the rent side of it, looking at the sort of demand side on the growth, there's limited construction supply coming to this pocket as well. That just gives me sort of a general top level confidence that there's, this deal has good characteristics to be a strong value add play that not only underwrites well, but is a deal that we think we can execute against in reality. And so I mentioned kind of starting off with this sort of top level income analysis, and then, looking at the comps in this pocket. Hey, let me show you guys the location here first. So this is scrolling out here. This Dallas Fort Worth. So we're up in the what's called the far north pocket of Dallas. McCallum sits right here. This was originally built as one giant, call it roughly 800 unit block of properties. We bought this middle section here. This has since been subdivided into 3 different properties, and this is a different asset altogether, the Gables at McCallum. So we're sitting here in this middle block. I don't know if you are familiar with Tides Equities, but they're a very, very prominent value add buyer. They bought the 2 properties to the east and west of us in 2021. They've also been in the middle of executing a value add plan. And so even before I saw the Tides deals, that Tides is next door to us, and they were successfully executing their plan. Knowing that just gives me confidence, and looking at the rents that they're getting, and again, kind of triaging that with my own analysis around the incomes, it further gave me confidence that we've got the ability to push the rents here, given that, not only are these comps because they're nearby and they're similar vintage, but they are also predominantly 1-bedroom units. And because they were all built at the same time, they have very similar floor plans. So we've got a very good case study to the east and west of us here. We've got some other 80s product here that's at a higher price point than even the renovated units here at Tides. We've got some lower quality 80s product here that's not really a comp because of the renovation quality. And then zooming out a little bit, so this property, here's the George Bush Parkway, which is a major thoroughfare through Dallas in the Fort Worth area. We're about a mile off of that road. We've got some higher quality 90s and 2000s deals here. There's some high-end new construction here. This whole corridor is all brand new retail here. There's a whole new retail block going in down here. So we often look at, not only kind of the residential apartment side of things, but we also like to look at kind of what's happening retail-wise around the property, who's investing in the area from a retail perspective. Those big retail chains like Whole Foods, Target, your grocery stores. I mean, they have just massive demographics teams that, are far better at demographics than any of us are. And, we like to, again, kind of piggyback on their analysis and their data to kind of further give us comfort that, this is a strong pocket. People are investing here. People are moving here. The demand side of the equation is right here. And so within this, general submarket neighborhood, there's also a University of Texas at Dallas campus right to the east here. And this is where you have all those $500,000 plus homes kind of circling these older apartment assets here, which are, again, starting to gentrify and turn over. So we feel pretty good about the location. And, we're bullish that over time, that the resident base is here to not only afford our pro forma rents, but also, continue to turn over and gentrify this whole pocket, which we think we think these deals will continue. These other deals that are not renovated yet will continue to trade, and we think we're rolling in the right direction here. And so, the comping on this deal was fairly straightforward because we have kind of the Tides deals next door. We've got Chatham Court Reflections, and we've got another 80s deal that's about a mile away. So all of my comps here are very tight to the property. I didn't have to go too far out to find a strong comp story. And, our pro forma rents are, again, we're not really trying to mark all the way up to market. We're basically trying to mark to the Tides deals or a little bit less than them. Their renovated units, I know this says the averages are 1,000 and 1,085, but their renovated units are more like 1,150 to 1,170 right now. And, you know, our blended average pro forma renovated unit on our 1 bedrooms is, we're trying to keep it below 1,000 just to be a little more conservative on the underwriting. And then, you know, how that translates over time into the revenue side of things is, you know, we've got our in-place rents here. These rents are a little bit dated compared to what I just talked to you about, but basically we've got a blended pro forma rent of 1,015, and we've got an in-place rent of, call it roughly 800. And so, you know, we will roll these renovations over a 24 to 30 month period. This is a large asset, so it's gonna take us a little bit longer than it might on a 200 unit or 250 unit property, but we'll roll these rents over 24 to 36 months. And again, we've got our kind of blended average rent here of 1,115, which again flows back into the first worksheet I showed you, which is just my sort of napkin analysis on the affordability. And so, you know, there's usually a few iterations of this, adjusting the rents, looking at the comps, looking at the incomes, but, you know, we generally always sort of stick to the guns here, where we want our pro forma rents, even if our comps are showing pro forma rents at below 3x multiple, you know, we'll try to do everything we can to keep our pro forma rents at least at 3, because, you know, our tenant screening protocol in all of our properties is 3x income, which I know in some pockets of Dallas has become a bit unaffordable, but for this deal with where these rents are and where the incomes are, that's our strategy on the resident side of thing, to ensure that we are bringing in qualified residents who can pay these rents. So I know that was a lot to run through as well, but I hope that was helpful.
That was excellent as well. Thanks, Nick. One of the questions, you were back there on it, but one of the questions that come up, I think you may have mentioned it, but it was just what the comments between trend and untrended.
Yeah, so, you know, the untrended rent is just the pro forma rent. Like if today we were able to mark all the markets, all the renovated units to market, that would be our untrended rent. The trending takes into effect sort of our projected rent growth from, you know, the organic market rent growth over time. So that's the difference. But again, we like to look at both, because, you know, particularly the last couple of years, I'm sure you guys have all seen some pretty crazy rent projections on pro forma rent growth. And so we like to make sure that not only are our untrended rents affordable to our residents, but also our rents with our trending assumptions.
See any other questions, or you get somebody, you can raise your hands. There was a question. Do you know if Tides had tried to get this property at some point as well, or any background on that side of things, Nick?
I don't know. I don't know if they tried to buy this property. You know, we bought the property somewhat off market. It was going to go to market, but you know, we had a buy side broker relationship that had a good relationship with the seller. They were in the middle of putting together a full marketing package with one of the Dallas broker shops on the property, and we were able to preempt the deal essentially and get to a price that worked for the seller. And, you know, the sell side broker was still involved, but we had our buy side broker as well. So, you know, we probably were a couple weeks ahead of it actually kind of coming out formally to the market. But and as far as, you know, when the Tides picked up those 2 deals, I don't know I don't know how they got those either, if those were off market, or I don't believe those were brokered. I don't remember them. I don't remember seeing them, but, you know, they could have been sent to a small group of people. I'm not sure.
Okay. And I think you kind of answered one of the other questions, which was, you know, somebody was asking about how do you, some of these deals was how do you find these deals or these off market or through brokers every time? You want to take it first and then I'll share a bit about our side of things?
Yeah, absolutely. So, for us, the brokers are really absolutely, they hold the keys to the kingdom. They're tremendously good partners. They're very helpful in all aspects of these transactions. So, when I say off market, I'm not talking about sending offers to owners directly from us. We'll do that through brokers, for kind of a couple reasons. One, a lot of these owners of these larger deals, they get constantly inundated with offers from people. And if it doesn't come through a credible broker that they know, like, and trust, they're unlikely to take it seriously. And so for us, we're happy to pay a buy side commission if needed to help get us access to a deal that way. And also, the more deals, you do with active brokers, the more deals you see too. So for us, we feel like we want brokers to be in the process. They're a huge part of the process. They're very much a value add. They've got a lot of great insights. And so we're constantly trying to build those relationships and momentum with a variety of different brokers in each of the markets that we're active in. That's our approach.
And I would say, it's very similar. We at Massive Capital, we probably have a blend of what's actually some of the things truly off market and things that are, the brokers are bringing it out, and a typical broker off market, as well as you're not the only one seeing it.
That's right.
Usually. It's a handful at least, if not more, depending on, the strength or where the seller is. We had some really interesting discussions lately with brokers about off market versus on market. And, a little bit of the concept is right now in today's market, you may prefer something that's more on market because an off market deal, is possibly not even a real seller. They're just fishing around and want to see what they can get.
Yep, that's very true. I mean, I think as you look at more and more deals, you got to find a way to protect your own time too, right? Because it takes a lot to underwrite a deal and really do an analysis. You want to make sure that what you're looking at is that they're actually a real seller, right? And to Mike's point, they're not just fishing for a number. We do one more thing to add. One more thing to add to what I mentioned before is, we do take a proactive approach to the off market through broker, strategy I discussed, where we'll, through CoStar and some other resources that we have, we'll run full lists of deals in submarkets that we like the demographics and story for, and try to identify the 5 or 10 deals that we think are underperforming in the market for whatever reason, and try to come up with a napkin valuation. And then we'll call our broker relationships and try to talk through the deals with them and see if they know the seller, if there's a reason that these deals are underperforming. So it's really not, I do think it's important to try to be proactive on the deal flow side of things, not just wait for a broker deal to hit your inbox. But I do think involving the brokers, there's a lot of value there that I think can be untapped as you build those relationships.
Yeah, thank you. And then Brian, go ahead and unmute yourself if you want to ask your question.
Hi, thanks. I appreciate all the information this evening. Nick, I'm in the Dallas area as well, and my question is directed towards you. I've got a 54 unit in Garland, and the numbers are very similar to the numbers of the McCollum project, which I lived in those apartments years ago. But it's only 54 units. Is that too small because of scale? Do I not want to mess with things under 100, 150 units? Do you have a limit of what you'll look at? And just, to my nature, I come from a single family home investment. I've always passively invested in apartments. But these are a couple that we bought houses from before, and now they're divorcing and they own this apartment complex. So it's in a great location. We love it. But again, it's only 54 units. And to me, that seems tough. If you're going to do this, you might as well go big.
Yeah, That's always a tough question to answer, right? I'd say just for Hampshire, for us, 150 units is probably our minimum size, because of scale and efficiencies, and really because we're not self-managing. I think you need to be at least in that 80-ish unit plus range for a third-party manager to probably make sense for the deal economically, at least in my experience and opinion. But I think, look, if it's a really solid 54 or 20 unit even deal or 40 unit deal, and you can handle a little more hands-on activity on the management side, and you're getting it at a great price and there's a good story there, I mean, it's absolutely a fine thing to buy, but just know that you're probably stepping into maybe more work than you would on something of scale. But, I think as you were probably getting to, it is essentially just, assuming you can solve on the capital side, it's just as much work to buy 50 units as it is 200. But I think it's the smaller you go, I think the more involved you need to be prepared to be from an operations standpoint.
Yeah, and that's not what we're doing this for. So, yeah, I appreciate the information. Thank you.
Yeah, I mean, yeah.
Oh, go ahead, Nick, sorry.
I was gonna say, just, unless you can find a partner who wanted to operate it and you were more capital and strategy or whatever your role would be in it, I mean, there's still ways to get involved in smaller deals. You just might need to leverage other people if you don't want to really be the one answering the phone at 2 a.m. when a toilet breaks.
Well, I mean, I don't mind that too much. Being small and single family, I'm doing that kind of anyway, but that's not the goal of where I want to end up. And I have been trying to partner because I don't know how to underwrite I've never underwritten a commercial apartment deal. And they were taking offers. They had an offer that kind of got backed out of when the market changed. And so now we're having to reset their expectations of what it's worth. And they just want an offer. So I called a few people, and again, that's what I'm getting the sense that it's just not a big enough project for the people I know.
Sure. Yep.
Brian, if I can give a little perspective on that, I think a lot of us went from single family to multifamily and, development and all of that. There's a lot of different layers of all that. But, I have the feeling that I was in that situation one time years ago. And, if you know the people, you've got a relationship with them, you're willing to do the management of it, or you get somebody to help you, I wouldn't make the decision just based on size. I mean, eventually we all say, yes, it takes just as much work to do a small project as a big project sometimes. But, in your situation, I kind of would encourage you to really think about it seriously and then move up to larger deals. And we always say multifamily is a team sport. So what you learn on this property, maybe with one or two, buddies with you or something, you'll translate that into larger properties in time.
Yeah, we've got me and a partner, and the money raised is not what bothers me. We can get the money for it. It's making the right offer and knowing how to do that. And I'm afraid my learning curve is going to miss this opportunity, so learning how to underwrite, but it's driving me down the path, and I'll get there. So
Sure. Well, good luck with that.
Thank you. I appreciate it. It's been great.
Yeah, and just continue joining us, Brian, and eventually, we can connect with some of us, and we'll get eventually maybe an opportunity to take a look at whatever you're looking at as well. And part of our goal as Massive Capital is support others along the path to doing their deals and getting into owning their own opportunities. So I'll share my information here as well, and you can reach out to us and just continue to get connected. We'll put you into some of our group chats that we have around Texas and other places.
Yeah, it'd be great. It's funny. I'm during the day I run a talent acquisition team, recruiting talent, and I was recruiting a guy one time, and I told him over the phone about Think Multifamily, and was thinking I was joining it. He said he mentioned you like real estate. I never joined. He did. He's got 4,000 doors under his belt, and I invest in his projects now. So action, really, I kick myself now because action really works if you take it and not just give advice.
Yeah, just connect with us after, we'll follow up with you soon.
Yeah, Mike, I really appreciate it.
Okay. And then, I think we'll take, I saw one other question in the chat, which was, and I appreciate a lot of the great comments here. One of the things was, what percentage of debt are you taking on, and what is your ideal hold period for something like this of, and I guess, assuming the McCallum communities as the property in that case, in this case.
Sure. Yeah. So for McCallum and really a lot of deals that we're looking at right now, and Mike, you guys are probably doing the same, but we assumed an existing 2.9% fixed rate product on McCallum. So, assumptions of lower fixed rate debt, it's a Freddie Mac loan. Certainly something that's more attractive than it was 12 or 18 months ago. But that loan also has 12 months of IO left. So we get a little bit of that interest only grace period while we start the renovations before we start to amortize. And so that, and the way we modeled that deal was a 5-year hold, no refi. So just a very clean, straightforward underwriting, not juicing IRR with a refi in year 3. So, it's 2.9 fixed. I think it matures in 2030. So we got a bunch of runway on that. And, even if we sell the deal in 24 or 36 months, I don't think the rates are going to be below 2.9. So we should be sort of at a 1% prepayment and not fall into a yield maintenance or defeasance type situation. So it was attractive for us in that regard. The loan, the biggest issue with assumptions today is, are you getting enough leverage, or how much leverage are you getting? And I want to say we were at 52 or 53% of purchase price, which is pretty good right now. And that's kind of what you might expect to get on a new agency loan today. Maybe you do a little bit better but you have a much higher interest rate as well. And the low leverage was also attractive to our institutional capital partner. They like that sort of fixed rate de-risked situation in this environment, which we absolutely agree with.
Thank you. Appreciate it. Yeah, we're following similar and looking at, similar deals and other locations in the same manner. And, just understanding, how much work or where do you need to go, and when will be your opportunity to get out, and where will interest be at that point versus where you are now, or a couple of things. So we'll take another question. Barbara, you had a question. We'll go ahead and just go. You got your hand up, I think.
Yeah, absolutely. No, I appreciate it. No, thank you for sharing. That was really an in-depth analysis and very well done with a lot of great insights. I think the only one question, I put it on the chat too, is in regards to crime rates when you're in areas which are kind of like, still in a conversion kind of environment. Are there any strategic measures you're utilizing in assessing that? And also, are there any any things, being put in place to help to make things a safer place for everybody? I know it's a loaded question. I know. I'm sorry.
Yeah, Mike, what do you guys use for crime? What do you use for crime data? Do you use city data, or do you guys use a paid source, or what do you guys?
We do not use any paid sources. So we use just a number of things, like was already mentioned, between kind of looking at the demographic of the incomes and the properties around it, as well as there's as well. I think there's a few other. I don't know if it was Neighborhood Scout you mentioned, but there was another one that we used besides Justice Map, and then we just kind of bring that all together to kind of collectively kind of see if it is a heavy crime area or not, and then how do we, after that assessment, is how do we deal with that, and work with that.
Yeah, I mean, I think crime's tough because it to me, if it's a high crime area, I mean, for us, that's sort of a non-starter. If the incomes are low and the crime is very high, that's not really something that we're interested in. But if the incomes are high and the crime is high, it could just be a function of the concentration of apartments, because that often can spike the data to a degree if it's in a sort of micro market. And then it just comes, but oftentimes for me with crime, it's an operational risk, right? So it's tenant quality, it's having to do more security cameras, possibly having to hire physical security. So those are all operating expenses or capital expenses up front that you'll need to think about. I mean, crime is manageable even in bad areas, but I feel like if you're going to buy a property that's got tough crime data around it, you just need to underwrite and plan for it. And, it's probably not something you're going to eliminate. And it's at best something you're just going to manage over your life of the investment.
Got it. Thank you.
And I think, the returns, you should expect better returns for something that's going to be more risk and, probably have a higher level of risk and more operational headache than you would if there was a deal with better crime data or better demographic area.
Yeah.
Thank you.
And also some people have seen it. I just want to let you know, we'll put it in the chat, as well, if you want to see this deal that we talked about today or other deals available. And you can also, it'll help you be connected with Massive Capital going forward as well. So I didn't see any other questions. So a lot of thank yous, and I appreciate everyone coming out tonight. Many of us will be in Aventura over the weekend, Friday, Saturday, and Sunday. We have an event on Friday night and Saturday night that Massive Capital and Legends are putting on together. It's going to be at the Courtyard by Marriott. If you've been there before, it's pretty much the same, but we're doing a couple nights and making it a bit bigger, and we're going to do a little bit more each time. So y'all are invited to join us there. Connect with me or Alex. Lovely if you are able to join us. So Nick, anything you want to share closing out?
No, it's great to be here and nice to meet everyone. Thanks for having me, Mike. Appreciate it.
Yeah, this was awesome. I love to see what you guys, that's great seeing how you guys are doing it as well as us, working on these projects together. It's an awesome time. And, right now is going to be, coming up now and next year is going to continue to be some opportunities. So, we'll be there and we'll be sharing with everybody. So thanks again. And y'all have a great night. I put some of my contact information in the chat as well. If you want to reach out, you can just text me at least, get started, share your information, and then we'll go from there. Thanks a lot.
Thanks, guys.
All right. Thank you.
Thanks, Paul. Appreciate you coming. Jasmine I wanted to shout Jasmine out earlier in the thing. So if y'all hopefully know Jasmine Salinas, one of our Jasmine, just say hey. You're going to be in Florida with us as well, right?
Yes, I'll be there. Looking forward to connecting with you all. And thank you so much for everybody who was here. That was great information. So thank you all. We look forward.
Jasmine did our first live video, or we did a webinar. Jasmine was live at McCallum for one of our webinars. So that was awesome.
Gotcha. Great.
Thanks a lot. Good night, everyone.
Thank you.
Thank you all. Bye-bye.
Bye.
Thank you so much.
Thank you. Take
Thank
care.
you, everybody. You see you, Mike, on the seminar.